Thank you everybody for coming to my presentation this year. Hindsight is always 2020. I figured it was a good title since we're entering a new decade. I'm Jennifer Tozser, Senior Vice President, Portfolio Manager at National Bank, and I want to thank you for taking the time to come this year. So the first thing I actually wanted to do before we get started is actually recap a little bit to last year. Because what I had said at the end of last year's seminar was I was very confident that 2019 was going to put up big numbers, but I was worried that we were going to have modest returns. So this is what happened, and I want to show you. And I'm going to pick on CIBC stock here because it's easy to follow. So we're going back to 2018, okay? So January 1st, this stock was $122. This is 2018. And at the end of 2018, it had fallen to $101. So that was a decrease, we'll call it close enough, of 22%. So this is what I was talking about last year. So I said, in 2019, what's going to happen is this stock and a lot of stocks in Canada are going to have a super low starting point. And when I was writing this presentation in November, sure enough, CIBC stock was back at $115. So you can say, great, isn't that great? The TSX, it's up 15%. Isn't that wonderful? Except if you owned that stock and if that was the only thing you owned, really it was at $122 2 years ago, and now you're back at $115. Now, what was different for us as a group is we actually started at approximately not at minus 10. We actually started this year at about +2. So the numbers that we put on were actually excess profits. So we were actually in a good spot overall. Okay? Okay. So, here's the agenda that I was going to go through for this year. And also, what I expect that we're going to see for return this year is, again, probably in about the 5 to 7% range. And you know with stock market returns, we don't get 5, 5, 5, 5, 5. We get +15, +2, +3, +8. It's not linear, but I expect it to be a good year. But I am going to also talk about all the concerns that we have that are going on out in the market this year, such as interest rates, the election, potential recession, so things that are on your mind. So that's what's on the agenda. Is there anything else you would like me to talk about? Okay. So this was a great slide. We heard a lot about this last year. The PMI index dropped below 50 and everybody yelled, oh my God, we're in a recession. But if you look at this, well, what's a global recession? Let's talk about that for a minute. Did we really care that for the last 30 years, Japan has been in a recession? Probably not. So just because it dipped below 50 for a moment doesn't mean that we're necessarily going into a large recession. And if you look at the Eurozone, that's been more troublesome in my opinion, but we currently aren't invested there. So I'm watching for a change in trend in the Eurozone. And let's talk about this. The U.S. bull market's been so long. It's the longest cycle ever. You hear that a lot on BNN. But if you look at how much profit we've made, so far we've only made about half of the profit that we made in the 1960s bull market run. And by the way, it's not the longest bull market run that's ever been out there. Take a look at this graph. A bull market, and I think you should compare a bull market run to a sports team. So if you go back to a hockey team, a stronger team has a better ability to absorb weak plays. A weaker team just can't recover the same. So there's potentially a lot more steam left in this US bull market. Any questions on that? No? Okay. Now I do change topics relatively quickly. So I'm going to talk about another thing you'll hear on the yield here all the time is yield curve inversion means recession. So I love this bullet. It says only twice since 1957 in 1966 and 1998 has a recession failed to occur with an inverted yield curve? If you read that, that sounds very ominous. However, guess what? You can get false signals. 39 times in 1968, 29 times in 1998, they got false signals and no recession. So far, we already know that we didn't have a recession in 2019. So here we've had 5 inverted yield curves so far. So I'm going to tell you that we're probably going to hear more on the news about the inverted yield curve. And that does not necessarily mean we're going to have a recession. It's definitely something to consider, but there have to be other contributing factors as well. Any questions about that? Do you know that there's a test at the end? Okay, so let's just assume that I'm wrong. Let's assume that we do have a recession. You can answer this question for me. I just want to know what you think. Do you think that a US recession could cause a Canadian recession? Yeah, okay. Do you think a Canadian recession could cause a US recession? No, I don't think so either. So let's assume we were potentially going into a recessionary situation. You'd want to start from the location that had, just like the hockey team, that had the best point of strength at the outset. And when you talk about recession, what is a recession? A recession is technically 2 quarters of negative GDP growth. So we're not probably going to see one in Q1 of. So unless everything falls off the cliff at March, so I'm not really looking towards a recession next year. Now I'm changing topics again. I'm going on to bond yields. Now, look at this table. All that red, those are negative bond yields. And there are more and more negative bond yields out there. Now, if I suggest to you about a negative bond yield, you should all shake your head and say, well, what is that? Well, you should, because it doesn't make any sense. If you look at that Swiss bond in the top row, what that's basically telling you is if you invested in a Swiss bond for 30 years, you're guaranteed to lose approximately 0.5% per year for 30 years. Now, who would like that deal? Nobody, right? So if it's not a good deal for investors, who's it a good deal for? It's a good deal for governments, the lenders. They're out there. Now, how do you get negative bond yields? Well, you get negative bond yields for a couple of reasons. It's a function of what happened with quantitative easing, but it's also because there's a mandate where people have to buy those bonds, right? It's called liability matching. Pension plans must buy their bonds. If you're a Swiss pension plan, you have to buy Swiss bonds. If you're a German pension plan, you must buy German government bonds. If you're a Canadian pension plan, you must buy Canadian government bonds. So there is an actual structural demand that keeps these interest rates currently low. And I think that you just need to know that this is out there. Now, if you look at these rates and you ask yourself, who's taking advantage of this? The answer is businesses and not households. So if you come back to economic theory, theoretically, when interest rates are so low that they're basically free, like in Switzerland, what you should be doing is going out and borrowing as much money as you can because the hurdle to profitability has just dropped. But what's happened is that people are still remembering that they had too much debt in 2008 and they're not spending their capital. They're hoarding it. So that's why what you're seeing is the increase in borrowing at the business level, but not at the individual level. So imagine, as I said to you as an economist, I say, look, everything's cheap in Calgary right now. I want you to go out and I want you to go mortgage your house and sell down your portfolio and start a business. Now, who thinks that's a good idea? Who thinks it's a good idea for somebody else to do? Right? That's the issue. And now I'm going to talk a bit about inflation, where I think we're going to hear more about this. And I'm going to give you some mixed signals about inflation and unemployment. When unemployment is low, I would instinctively think that's wonderful. Everybody's working. Everybody's paying taxes. The economy is running full steam ahead. But there's a but with that. The but is that what do governments want? Governments want growth. They want GDP growth. So if you have nobody that's unemployed, you don't have anybody that you can hire so that you can get growth. So you generally have, and I'm definitely oversimplifying, but you have two ways that you can generally fix that. You could either, one, tell everybody to have more children, and that has about a 20-year lag, or two, you can use immigration. And the issue with immigration is you have to make sure that you immigrate the people that do the job you want them to do, or you could potentially have a different issue. And you can see, because we have full employment, that we're starting to get an uptick in wages, which is early onset of inflation. Now, when I talk about inflation, everybody generally thinks, inflation, 1980, I'm going to lose my house, everything's going to be a disaster. But that's the end of the inflation cycle. At the beginning, inflation is actually okay, and maybe actually good. And to prove it to you, I put in a slide with a lady in a dress. So here's why governments like inflation. They like inflation because if you borrow money, $1 million in 1920, it's a lot easier to pay it back with $1 million of money that's made in 2020. That's what inflation does for you. It makes old debt cheaper. Is everybody with me on that one? Right? So what you could buy for $100 in 1913 cost you $2,200 in 2010. Governments also like inflation because if inflation is out there, that means you've got the economy's running on full steam, everybody's employed, you could probably raise interest rates a little bit, and that means if there's a problem, you can turn around and drop them. They love to decrease interest rates. If you don't have that little bit of inflation, you can end up in a deflationary spiral like Japan has been in for the last 30 years, where what you have to do is you have to keep convincing people to go spend their money. And that's very difficult to do. Kathy, go spend your money. She's already laughing at me. It doesn't work. And in addition to that, the $1 million you borrowed in 2018 is double. The $1 million you borrowed in 1990 cost you twice as much money to repay because you've got deflation, so the relationship changes. Okay, so it's even more difficult. And because of this, you're going to potentially, this is a brand new theory that's out there. When I say brand new, they're teaching it at university. So it's not last week brand new, but I think you'll be hearing more about it. And it's called MMT, Modern Monetary Theory. I'm not going to talk about it a lot. I just think you should know it's out there. And what it's really about saying we're not going to balance tax revenues with spending. We're going to pay more attention to inflation and unemployment. And this only works, by the way, it doesn't work for somebody asked me, said, like the NDP government in Alberta compared to the Conservatives. No, it only works if you're a sovereign who can print your own currency. That's number one. And number two, it doesn't believe in increased taxation. Okay, so it's a very different concept. But it's something to watch for in the future. Because countries that are struggling with deflation have to look at something else because they can't just lower rates because it's not working, and they can't just tell people to spend their money because it's not working. Any questions on that? Good, because if you had them, I'd be referring you to Stephanie Kelton. Now, moving along, this is about the Chinese trade war. So what I wanted you to know is that this has become a bipartisan issue. And what that means is that the Republicans and the Democrats are equally interested in the issues that originally got raised by Trump about China and the trade that the US does with China. So because of that, there is really no more pressure for Trump to come to an agreement with China before the election. Now, I know there's been a first round of agreement that's happened, but there's no real pressure because both of them know that there are issues with the relationship that China currently has with the US. And by the way, there's no pressure for China either. For China, their trade with the US represents 3.4% of their GDP. Now, 3.4% of Chinese GDP is a huge number. Okay? But for China, they can easily make that back up in infrastructure spending. So for China, it's not a big number. For places that China spends their money, it's a big number, like Europe, like emerging markets, but not the US. Okay? Any questions on this? Okay, now I can't believe I put this up here, but I am going to talk about the US election. I'm only going to talk about it in the context of making money. I can't have a political debate, and you have to accept my assumptions. Everybody okay with that? Okay, so my first assumption is that if you have a successful economy, the current president gets reelected. So on that note, whether it's President Trump or a different Republican, they'll probably get it reelected. And it doesn't matter to me whether it is Trump or it is somebody else, because economically things probably won't change in the States or for us in the stock market. So who I'm interested in are the Democrats. Now, this Democratic presidential race started with the largest number of Democrats ever at 27. By the time I was writing this presentation, it was down to 15. And I just wanted to highlight 4 who I thought were contenders and very interesting that should be addressed. Does anybody know my 4 people here? Want to tell me? Go ahead.
Biden, Warren, Bloomberg, Saunders.
That's it. You win. Thank you. So what I've done is all the information I got here on this slide, I actually got from a great article called Business Insider. It details what all of the candidates think about all of the issues. I only picked out the ones that I wanted to talk about on a very superficial level. So when I read about Joe Biden, he sounds like a very traditional candidate to me. You know, he could be Clinton, he could be Obama, he could be anybody that's, you know, a very typical Democratic candidate. When I read about Elizabeth Warren, I think, okay, she's way out there. She's almost like an activist, down with business. Everything is terrible. Everything has to change. And Bernie, who's made a fortune by, because of the 2016 election, raising his campaign dollars at $25 a pop, is kind of like, I'm one of the little guys. Now, he doesn't like big business either, but as one of the little guys, he's going to help you change it. And Michael Bloomberg, when you read his platforms or his policies, you wouldn't know that he was a Democrat, except he told you he was. So as far as this is considered for the election, you know, who people are really worried about here are Elizabeth Warren and Bernie Sanders. And the reason people are worried about the two of them is that they actually represent the most different type of candidate than they have seen in the Democratic Party in the past. And if either of those two people actually get into power, the concern is that they will be able to make enough change, fundamental change, to legislation that it could adversely affect the U.S. economy. That's the concern about the two of them. So here's my analogy. And you might be asking me, why would I put this up? The reason I put this slide up was because the best analogy for the 2020 election is the 2016 election. And going into 2016, it was very widely accepted that if Hillary Clinton won, everything in the stock market would remain relatively the same. And if Donald Trump won, we were looking at an immediate 10% plunge and then massive volatility. And we know that that's just not what happened. So my summary is, we don't know what's going to happen. But what we do know is we're going to get more volatility, and that's okay because we actually have a portion of your accounts dedicated to making money from volatility. Is that helpful? Okay. Now, one of my clients said to me, Jen, you're always so positive. You know, you generally don't talk about things that are negative. And I did want to talk about the Canadian economy for a bit, because a lot of clients over the last 3 to 5 years, if they've stuck with that Canadian dividend paying portfolio, like this illustration, just haven't made money. You need to look elsewhere. And you can see that reflected in how happy they are with their finances. As a whole, Canadians are becoming less and less content with where their finances are. And I was actually, Labe invited me to this oil and gas seminar and I haven't been to one for 5 years. And I wanted to talk about that for a minute, because I think that by talking about this presentation I saw, it gives me a good idea of what some of the frustrations are that are out there. And I'm picking on Vermillion. I'm going to tell you, I'm picking on them because they're a good company, they're a big company, they're a well-run company, and I think they can take it. So I'm going to pretend I'm Vermillion. I've pulled out a few of the slides that their investor relations guy gave, and I'm going to give you the summary of how he said them. So I'm going to go through pretty quickly. We're growing at 15% per year in production. Aren't we wonderful? And by the way, look at this FFO. Look at how much money we're making. Isn't it wonderful? Look at our dividend. We've never cut our dividend. We've had a constant distribution. We're currently at a rate of dividend yield of 15%. And I'll be honest, at this point, I'm thinking, geez, I should maybe be looking a little bit more closely at this stock. And then they lost me on the next slide. And this was the next slide. And the investors relation fellow said, if you had invested with Vermillion, we would have created wealth for you. We've done better than the index. We've done better than our peers. We're a great long-term partner in your wealth management, whatever. And I'm sitting there and I get my calculator out and I'd realize that over the 12-month period, or the period of time that when I saw this presentation, that if you'd given this company $100,000, you had about $52,000 left. Now, that's a problem. And what bothered me about this presentation is that they never talked about why that was. They never said, because most of the people attending this weren't professionals. They were people that were managing their own money, that thought they were investing with a good company, that was doing all these things well, and didn't understand why their stock had fallen so much. So I wanted to talk about this next slide, and this next slide is an academic example of what I think is happening in the oil and gas market. It's a lesson. It's probably easier to follow along here, but of course it's in your notes. So if you were taking finance at university, they talk about the price earnings multiple. So the price earnings multiple is how many years of profits it takes to own the company. That's what it is. It's a way of gauging how expensive a company is. So in my fake made-up company, the profits grow from $10 to $22 in 5 years, but the price earnings multiple stays the same. It's always 10. So the share price grows from $100 to $220. Does everybody understand that? Could follow along? Okay. In the stock market, that wouldn't happen. What would happen is you would get something called multiple expansion. A company that has a good track record of growing their profits gets what's called an increasing or expanding price earnings multiple. So even though the company in the second line, which is in favor, has the same amount of profits as my textbook example, the stock price is significantly higher because the price earnings multiple grows from 10 to 14 times. So do you see that difference? And here's what's happening to the oil and gas companies. I will tell you they are unloved and getting no respect. So in addition to all of the headwinds that they've had to face with oil prices, profitability, taxation, et cetera, their price earnings multiple, this is also an academic, has contracted. So even though their stock price might naturally be falling, you're going to get a magnified effect because you have less people that want to actually buy the stock. So if you look at here in the first example, you can see the stock price, the profits go up 120%, so does the stock price. In the second example, which is more stock market, reasonable, you'd get a significant increase in stock performance. And here's what's happening in the oil companies. Is everybody with me here? That's exactly right. And you have to accept that. A lot of, when I was at that conference, I asked a question. They put out a price target for a stock, and I said, well, how did you come to that price target? I said, is it from increased profits? Is it increased sales? Or is it increased price earnings multiple? Increased price earnings multiple. Well, you can't control that. That is the last thing you get. And just because the price earnings multiple may have been 10 times for the last 25 years doesn't mean that's what it's going to be in the future. And if you don't believe me, you could talk to a Saskatchewan farmer. Every once in a while I run into one who says, did you know back in the 1920s, a bushel of wheat was the same price as a barrel of oil? There doesn't have to be a constant relationship. Relationships can change. So it can change. Does that mean that the company's not profitable? No. But it does mean that you have to be very careful if you're choosing to buy it as a stock in a portfolio. And if you're the president of a public company, is how do you make people buy my company? What do you do? Here's one thought right here. In Canada to Ovintiv. So now I'm going to read this, and I'm going to tell you how I perceive this statement. This was given by Doug Suttles, president, and chief executive. He said the move, so in Canada, moved to the States, moved their head office to the States and changed their name. So he believes the move will give the company greater access to foreign capital. So when I read that, what that says to me is that it's easier to attract foreign capital in the US than in Canada. Number two, a domicile in the US will expose our company to increasingly larger pools of investment in US index funds and passively managed accounts, as well as better align us with our US peers. So what that says to me is people are buying oil companies, just not Canadian oil companies. And the third line is the company said none of its head office operations are moving to the US, and the changes will not result in any job losses in Canada. And that makes me think of Nexen, who at the time of the CNOC acquisition had 3,200 employees, and now has 900, looking to rationalize another 300 to 500 over the next 12 to 18 months. So if you're the president of the company, you can go where people are going to buy your stock, or you can become so cheap that a sovereign wealth fund buys you, or a pension plan buys you, or a wealthy investor buys you. And then what will happen is, but what you need to get that price earnings multiple to go up is you're competing for dollars. And you have to do the things that makes you attractive. And I'm actually a huge fan and a huge advocate for Canadian oil and gas. So this is tough for me to say, but I have to say it, because otherwise we'd be sitting here with a whole bunch of Canadian oil and gas dividend paying stocks looking at negative 25 to 50%. Oh, by the way, if you didn't, dislike me enough already, I'm going to move on to a new game in town, ESG, environmental and social governance. So this is actually ESG. Has anybody heard of it? Yeah, okay. So ESG has actually been around since 2006. It isn't new, but last year was the first year that I really heard a lot about it from portfolio managers or companies themselves. So I went and got this report, issued by MSCI. It's free, and I thought I'd go through it with you. So it's on Microsoft, and what it does is it shows you the range of ratings you can get in the tech industry from CCC to AAA. Microsoft's doing really well. It shows you the history of its ratings. It shows you the distribution of where everybody else is in the tech industry. So you would think everybody would be a AAA, but only 5% are. And then it shows you where they're lagging or where they're great. So the reason it's free for me is, of course, MSCI wants to sell their services to Microsoft so they can figure out how to move up the scale. But why I think that this is interesting is because I can see in the future that pension funds or endowment funds or special purpose funds or charities could have a mandate where they say, and we would like you to have an ESG rating of single A. So if you're looking at two similar stocks, say two Canadian banks, and one has an ESG rating of AAA and one has an ESG rating of B, you're going to buy the one with AAA. And over time, that will create a higher price earnings multiple for that stock and ultimately potentially better performance. Any questions on this slide? Now, I don't use this as a determining factor for your portfolios, but I'm aware of it. Value and growth. So here's another thing about market bottoms. For when I look at value, you should just know that I personally am naturally biased towards growth. And why I am naturally biased towards growth is I look for long-term trends. That's what I look for. So that's been done well in the portfolios for a long period of time. And I always come back to the developing markets versus emerging markets. So more from a macro point of view. I consistently have heard for the last 5 or 6 years, emerging markets are cheaper, emerging markets are cheaper, emerging markets are cheaper. Well, you wouldn't have made any money in the last 10 years in emerging markets. It actually would have been a destroyer of capital. So I think there's all tons of different ways to make money in the stock market, but I just think you should just beware that, value or cheaper is not always better. Okay. And okay, the next question, is the US market, overvalued? Well, this slide suggests that over the last 20 months, you could potentially argue that the S&P 500 has just been consolidating and is actually ready for another bull leg up. And I like this one on market valuations. So if you look at this slide, it says, oh, look at that. In the US, the blue one, the price earnings ratio right now is 16.8. In 2008, the global financial crisis, it was 16.2. Well, I guess it's way overvalued. Now, what caused the 2008 global financial crisis? Yeah, the US housing market. It did not happen in the stock market. It got spilled over to the stock market from the housing market. The last major correction for overvaluation in the stock market was 2000. At the time, the Dow only did not have, and the S&P 500 did not have technology stocks in it. They were all completely segregated to the NASDAQ. Guess what the price earnings ratio was in 2000 on the Dow? Just guess. Pardon me? 16.2? Okay, good guess, but no. I'll take 3 guesses. Quick, come on. You can't be wrong because I have the answer. Take 12. 12? This is your blue chips, Disney, AT&T, GE, right before the big crash of 2000. Didn't recover till 2000 and, well, really for quite a few years. 46. It was 46 times. So when you look at this slide, put out by somebody who's trying to tell you that the market's way overvalued, positioned for a crash, it's not an overvalue. It's not like the tech crash, where the blue chip stocks were at 46 times. So there's a long way to go. That's my point. Is anybody surprised by that number? Yeah. Oh, and here we are, back to our friends in volatility, the auto-callable notes. So the reason we are going to continue to have volatility is because we have people make decision on sound bites. We have instant access to information. They hear it and they believe that instead of doing research, they now have the underlying knowledge of what's occurring out there from what they heard on the news or saw on the internet. So, and the ability to access or make decisions and affect trades is pretty much simultaneous these days. So you can expect to see more volatility. We're going to see more volatility in 2020 for those reasons I previously discussed, and because people want to protect their profits for 2019. So, auto-callable notes. This is also the reason we made money in 2018. So I'm going to go through this example. We've been doing these since 2013 on how they work. And they're not very intuitive, so I do this every year. So this was a live example. So in 2013, the S&P 500 index was at 1,400. So 1 year later, if the index is at 1,400 or higher, this note pays 8.25. If it takes 2 years, it pays 16.5. If it takes 3 years, it pays 24.75%. Okay, everybody knows this is all good. But what if there's a problem? What if the index never goes up? Well, these things have something called a barrier of protection. And the barrier of protection on this particular note was 20%. So at the end of 3 years, if the index was down by 20% from the starting point, your principal was guaranteed, but you didn't get any return. And then if the market was worse than 20%, which I call the disaster clause, it was minus 22, minus 25, that's what you got. You got negative 22 or negative 25. But you have to remember, most of the time these go up. And if it's going to go wrong, it's most likely it's between 0 and negative 20, then worse than negative 20. So, we have to have the disaster clause there. It's a tsunami wipes out San Francisco, the internet goes down for 6 months, whatever it might be. But I'm not too concerned about that. So here's the performance of these notes since we've used them. So in 2019, we had 13 notes that matured in their first year with an average return of 11.7. We had 3 notes that matured after their first year with an average return of 17. And we had 8 notes that are rolling into their next year. So since 2013, we've had a total of 66 notes that have come due with an average return of 10.6. And when markets are volatile, so next year, when you're watching the volatility caused by the election or the next, yield curve inversion, we get better rates on these things. So it works out well. And here's an example of, somebody asked me, well, why do we keep buying the same ones? Because the Canadian market's been relatively horizontal for the last 5 years. So we can keep buying the same ones. You get better rates on a horizontal market than an increasing market. So here's an example of if you'd owned the utility index and you'd bought it in 2017, because this came due in 2019, your actual 2-year return was 6%. So 1 year later, it was negative, but then at the end, you ended up with a positive 6% or 3% per year. But if you owned this note, you got 20. So this has been helping us make money in these horizontal markets. And will continue to do so while we have volatility. And finally, I wanted to see, well, whose are we buying? So when I go out there, I just see every week who's got what issued, which ones are the best, and that's the one I buy. Noticeably, Royal Bank is missing. Royal Bank's not missing because they don't have good terms. Royal Bank is missing because they don't offer them. So you can't get them at Royal Bank. National Bank, 35% of the time they have the best note, but 65% of the time somebody else does. So they're relatively equal across the group. And I don't know what it will be for next year, but whoever's got the best one is what you get, and that's what you should expect me to do. And the summary here just talks about how we're, I would allocate a typical portfolio. Of course, they're all customized for you personally. I think the biggest change in here is that I'm increasing the auto-callable notes from 10% to 15% because I do expect more volatility next year, and that's coming at the expense of Canadian equities. Your fixed personal bond weighting will be based on what you want, but it should not be less than 15% in any case. And as far as the markets are concerned, oil continues to be range bound, but moving up its ranges. Gold's got a big range. Natural gas is quite depressed. The US should be growing between 1.9 and 2.09. Even though Canada's decreased their GDP forecast, Canada has never had a recession if US GDP's been at 2%. So we just sort of follow along in their wake. So, it should be a good year. In addition to the research that we use at National Bank, these are other source providers that we pay for that help us design your portfolios. A note from our lawyers to say hello. Thank you.